Booyah, Jim.
Booyah,
Good fan here.
Thank you.
Yeah, question for NIO. Would you buy, sell, or hold out?
Answer for NIO. I would sell, and I would buy Ford if you can get it $12.75. I would say do it.
Expansion, analysis, and prospects. NIO's battery swap tech is making waves, and investors are taking notice. With over 40 million battery swaps completed and plans for another 1,000 stations this year, NIO's strategy is getting serious attention. In this video, we'll dive into the numbers, analyze the impact on NIO's stock, and explore what this means for the future of EV charging. Ready to uncover the details? NIO is betting big on battery swapping as the future of EV charging. NIO has forged partnerships with other major Chinese EV manufacturers like Changan, Geely, Chery, and JAC, recognizing the need for a standardized battery. According to Ding Luo, CLSA's deputy head of research, NIO's push for battery swapping is driving the current momentum in the industry. With the company realizing that building a comprehensive ecosystem requires collaboration with other players, the concept of range anxiety, a common concern among potential EV buyers, is a key focus for NIO. By offering battery swapping services, NIO aims to alleviate this fear and provide a solution that ensures drivers can always access a fully charged battery. Moreover, battery swapping technology boasts faster charging times than traditional charging stations, further enhancing its appeal to consumers. With NIO leading the charge in battery swapping and forging strategic partnerships to build a robust ecosystem, the company is positioning itself as a pioneer in the future of EV charging infrastructure. In addition, Shenfei, the senior vice president of NIO's power division, disclosed plans to extend battery swapping services to vehicles outside of NIO's own lineup. By mid-March, NIO had accomplished an impressive 40 million battery swaps across its network of over 2,300 swap stations, intending to construct another 1,000 stations within the year. Despite these achievements, most swap locations remain unprofitable, casting doubt on their contribution to NIO's bottom line. Moreover, NIO has conducted nearly 37 million charges through its public charging stations and aims to add 20,000 more this year, distinguishing itself as the pioneer in providing both battery swapping and charging access across China and Europe. NIO's power services and related products constitute about 10% of its overall sales, as reported by CNBC. However, the profitability of battery swap stations remains a critical concern, given their substantial installation costs, averaging around $500,000 according to mobility impact partner Shea Natarajan, whereas a two-port charging station costs between $200,000 and $300,000.
Priced in NIO, and I think if you want exposure, as we really had a hard time measuring, any asset manager, money manager out there has had a very difficult time measuring the reboot out of China and the zero COVID ramifications. This is why it's priced in. That's why it's down 45% over the last year, and that's why I want to be a buyer here from a trade perspective, but also, John, from a longer-term exposure to the Chinese EV market.
But let's not forget the harsh reality. NIO stock has taken a serious beating over the past few years, plunging a staggering 90% from its peak of $50 in early 2021 to a mere $4 today. It's been a tough ride for investors. This dismal performance starkly contrasts with the S&P 500's solid 40% increase during the same period. In fact, NIO has consistently lagged behind the broader market, with returns of negative 35% in 2021, negative 69% in 2022, and negative 7% in 2023. Compared to the S&P's gains of 27%, negative 19%, and 24%, respectively. So, what's the deal? Why is NIO struggling while others thrive? It's not just NIO that is facing these challenges. Many mainstream automakers, including Mercedes-Benz and Ford, are experiencing sluggish demand for EVs and scaling back their electrification goals. Even Tesla, the EV bellwether, had to reduce production amidst intensifying competition. With mounting pressure from competition and price wars in the growing Chinese EV market, NIO finds itself in an uphill battle for market share and profitability. Moreover, despite boasting a diverse lineup of 5 SUVs and 3 sedans, NIO finds itself struggling to capture a significant market share. In an effort to boost sales and entice traditional gasoline vehicle owners to make the switch to electric, the company recently unveiled a subsidy program worth 1 billion yuan, approximately $138 million. Additionally, NIO is actively advancing its battery technology and forging partnerships to bolster its battery swapping capabilities. Recognizing the need to expand beyond its premium price range and tap into new market segments, NIO is set to venture into the lower end of the market by introducing new sub-brands. One such venture, under the brand name Alps, is slated to commence production later this year. Now, did you know that financial writer Charlie Keough thinks NIO is not living up to its once sky-high expectations? Keough highlights several red flags, including the company's ballooning debt, currently over $4 billion. With interest rates hitting historic highs, the outlook for growth stocks like NIO appears uncertain. Additionally, strained relations between China and the West, coupled with the potential return of Donald Trump to the presidency, further cloud NIO's future prospects. Despite these challenges, Keough acknowledges some positive aspects of NIO's business. Operating in a rapidly growing EV market presents opportunities for the company to capitalize on. Moreover, NIO is diversifying its product range to attract a broader customer base, including plans to introduce a more affordable sports utility vehicle. However, amidst industry growth comes heightened competition, diminishing NIO's once distinguishing feature of cutting-edge battery swapping technology. Keough remains skeptical about NIO's ability to regain its former glory and advises caution to potential investors eyeing its seemingly cheap shares. While NIO's trajectory may have deviated from its initial hype, Keough maintains a watchful eye on its performance, but for now, he's not convinced it's a buy. But before we move on, we just want to thank you for watching this far in the video. Furthermore, 10 analysts have recently weighed in on NIO, offering a range of perspectives from bullish to bearish. According to their ratings, the sentiments have varied over the past 3 months, with some analysts expressing bullish or somewhat bullish views, while others remain indifferent or even bearish. Examining their 12-month price targets, analysts have set an average target of $6.18 for NIO, with a high estimate of $10 and a low estimate of $4. This average target has decreased by 23.7% from the previous average price target of $8.10. Delving deeper into the analysis of recent analyst actions, it becomes apparent that there are several factors influencing the perception of NIO by financial experts. One such factor is the company's market capitalization, which currently lags behind industry benchmarks, potentially due to constraints in size or other operational factors. Additionally, NIO has faced revenue challenges over the past 3 months, experiencing a decline of approximately negative 10.3%. This revenue growth rate falls below the average among its industry peers in the consumer discretionary sector. However, despite these challenges, NIO's net margin remains impressive, surpassing industry averages and indicating strong profitability and effective cost management. On the other hand, NIO's return on equity falls below industry averages, suggesting potential challenges in efficiently utilizing equity capital. Similarly, while the company's return on assets excels beyond industry benchmarks, its debt-to-equity ratio is notably higher than the industry average, indicating a higher level of financial risk as it relies more heavily on borrowed funds. Now, could NIO reach $10 per share? According to Morgan Stanley analyst Tim Seow, it's possible. He reiterated an overweight rating on NIO's shares, expecting them to reach $10 per share, which would represent a significant upside of 124% from current levels. Seow and his team highlighted NIO's relative strength in sales, particularly in March compared to the prior month and year over year. Sales of NIO's SUV models grew by over 40% month over month, while smart electric sedan sales increased by more than 50%. Even though sales met recently adjusted expectations, the company has begun shipping its 2024 models, boasting improved computing power and product competitiveness. Moreover, NIO has enhanced its battery as a service program, which could further stimulate sales. This program allows customers to save money upfront on the vehicle's cost and pay for quick battery replacements at swap stations across China. So now, considering NIO's battery swap program and its potential impact on investors, it's clear that the company is making significant strides in addressing the challenges of EV adoption. By expanding its battery swapping partnerships and enhancing its BaaS program, NIO aims to offer convenient solutions for customers while differentiating itself in a competitive market. Investors should monitor NIO's execution of these initiatives, as they could play a crucial role in shaping the company's future growth and market position. However, it's also essential to consider broader economic factors that may influence NIO's performance in the short term. So, do you think NIO's battery swap program will propel the company to new heights in the EV industry? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about NIO, just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.